So, let's talk about how small apartment investors can develop a tactical asset allocation plan. It's an important process and, well, getting it right can really make a difference in your investment outcomes. First off, you want to analyze short-term market conditions. That means keeping an eye on economic indicators, things like GDP growth, employment data, inflation, and interest rates. These help you gauge overall market trends. And don't forget about market sentiment. You'll want to evaluate investor confidence, volatility indices, and market momentum to get a sense of how people are feeling about the market right now. Finally, take a look at sector performance. Try to spot which sectors like real estate, technology, or energy are outperforming or underperforming. Next, it's time to define your tactical allocation strategies. You might want to make overweight or underweight adjustments, meaning you increase exposure to asset classes or sectors you expect to outperform, and decrease exposure to those you think might underperform. For example, you could overweight fixed income during economic slowdowns and equities during recoveries. Another approach is making defensive shifts, so reallocating to lower-risk assets like bonds or cash equivalents during times of market instability. And it can be smart to set aside a portion of your portfolio for opportunistic investments such as high-growth opportunities in emerging markets or undervalued sectors. Finally, you need to set parameters for your adjustments. That includes defining percentage limits, like deciding how much you'll overweight or underweight a position, say plus or minus 5% from your strategic allocation. You'll also want to determine the duration for these tactical adjustments, maybe something like 1 to 3 months. And of course, establish clear triggers for making changes, such as hitting specific economic data thresholds or reacting to major market events. Now, it's important to monitor and evaluate performance. You'll want to track the impact of tactical shifts on your portfolio's performance. Be sure to compare your results against benchmarks and your long-term strategic goals. And, don't hesitate to adjust your tactics based on market feedback and analysis. Okay, let's walk through an example of tactical asset allocation during a market downturn. So, imagine your strategic allocation looks like this: 40% in equities, 30% in fixed income, 20% in real estate, and 10% in alternatives. Now suppose economic indicators are pointing towards an imminent recession, and equities are expected to take a hit. In this scenario, you might decide to overweight fixed income by increasing that allocation to 40%, reallocating funds from equities. At the same time, you'd underweight equities, reducing that portion to 30% to help limit your exposure to all that market volatility. You keep real estate unchanged, since it provides steady cash flow and acts as a hedge against inflation. For alternatives, you just keep an eye out for opportunities in gold or other commodities. The outcome? Well, by shifting towards more defensive assets, you've reduced your portfolio's volatility and preserved capital during the market decline, all while maintaining your core allocations. Now let's talk about some potential implications for your portfolio's performance. First, enhanced returns. Outperformance in those tactically adjusted asset classes can actually boost your short-term returns. Risk mitigation is another big one. Defensive shifts like these help protect you against losses during downturns. There's also portfolio stability, since you're balancing short-term opportunities with your long-term strategic goals. But don't forget about increased costs. Be sure to monitor trading and tax implications that might come with making frequent adjustments. So, what are the real benefits of tactical asset allocation for small apartment investors? Well, agility is a big advantage. It lets you respond quickly to market changes, so you can jump on opportunities or cut risks as needed. Flexibility is another plus, since you can adjust allocations to reflect shifting economic conditions or new investment landscapes. Plus, it's a great complement to your long-term strategy, supporting your strategic asset allocation while addressing short-term market dynamics. And of course, there's risk-adjusted growth. You're balancing your growth and preservation objectives more effectively. To sum things up, tactical asset allocation gives small apartment investors the ability to adapt their portfolios to short-term market conditions, which can really enhance returns and help mitigate risks. By integrating tactical asset allocation with a solid strategic foundation, you maintain a disciplined approach while still taking advantage of dynamic opportunities. Regular monitoring, sticking to defined parameters, and keeping your long-term goals in focus all help make sure your tactical adjustments actually contribute to your overall investment success.